Price action trading is often misunderstood as a minimalist technique, a stripped-down version of trading for people who don't like indicators. But that misunderstanding misses the heart of it entirely. Because price action is not about using less information. It's about learning to read the only information that actually matters, the behavior of buyers and sellers, as it unfolds in real time. After decades in markets through the dot-com bubble, the 2008 collapse, and the COVID shock, I can tell you with conviction that indicators never saved me in a crisis. But understanding price did, because indicators are interpretations of the past, while price is the present tense of risk, fear, greed, and commitment. When I started out like most traders, my charts were crowded. Oscillators, moving averages, momentum tools, all stacked on top of one another, each promising clarity. What I didn't realize at the time was that I wasn't reducing uncertainty. I was outsourcing judgment. Indicators gave me answers, but they also gave me excuses. When a trade failed, I could always blame the tool instead of questioning my understanding. Price action took that comfort away. With a clean chart, there's nowhere to hide. Every decision is yours, and that responsibility is uncomfortable at first, but it's also where real skill begins. At its core, price action is about context. A candle by itself means very little. A pattern by itself means even less. What matters is where price is, how it got there, and how it behaves when it arrives. A strong bullish candle at resistance is not the same thing as a strong bullish candle breaking out of a long consolidation. One is effort meeting supply. The other is acceptance above prior value. Indicators often flatten these distinctions. Price action forces you to see them. One of the first lessons price action taught me is that markets move for reasons long before they move in ways that indicators can detect. Large players accumulate quietly. Distribution happens subtly. By the time indicators light up, much of the opportunity is already behind you, and the risk has shifted. Price action, when read correctly, shows you the footprints of that process. Tight ranges, failed, pushes, aggressive rejections, slow grinding advances. These are not random shapes. They are negotiations between participants with very different time horizons and motivations. Support and resistance, often mocked as simplistic, are actually foundational in price action, but not in the rigid way beginners use them. They are not lines that magically stop price. They are areas where memory lives. Traders remember pain. They remember missed opportunities. They remember where they were wrong. When price returns to those areas, behavior changes. Volume may increase. Speed may change. Wicks may appear. Price action is about watching that behavior, not predicting it. If price approaches a level and hesitates, that hesitation is information. If it slices through without slowing, that's information too. Another critical principle is the difference between rejection and acceptance. Rejection looks dramatic. Long wicks, sharp reversals, fast moves away from a level. Acceptance looks boring. Price spends time. It overlaps. It builds value. Many traders chase rejection because it feels decisive. Professionals respect acceptance because it tells you where the market is comfortable doing business. Trends are built on acceptance, not excitement. Indicators often chase excitement. Price action trains you to respect comfort. One of the hardest transitions for indicator-based traders is letting go of the need for confirmation. Indicators feel safe because they agree or disagree. Price action rarely offers that kind of comfort. It offers probabilities, not permissions. You learn to act when conditions align, not when certainty appears. That shift is psychological more than technical. It requires trusting observation over calculation. That trust is built slowly through screen time journaling and honest review of both good and bad trades. During the 2008 crisis, this distinction became painfully clear. Indicators broke down. Correlations went to 1. Signals conflicted or arrived too late to matter. Price, however, was telling a consistent story. Ranges expanded. Levels failed violently. Bounces lacked follow-through. Sellers controlled time and space. You didn't need an oscillator to see fear. You could see it in the speed of drops and the weakness of rallies. The same was true during COVID, when volatility exploded and traditional signals became noise. Price action wasn't easy, but it was honest. Another misconception is that price action means trading constantly. In reality, it often leads to less trading. When you read price well, you see how often the market is unclear, balanced, or simply rotating. Indicators tempt you to act by producing signals. Price action teaches you to wait for imbalance for moments when one side clearly loses control. Those moments are rarer than most people think, but they're also where risk-reward makes sense. Time frames matter deeply in price action. A pattern that looks powerful on a 5-minute chart may be meaningless on a daily chart, and vice versa. Price action traders are always aware of the larger context. Where are we in the higher time frame structure? Are we expanding or compressing? Are we near prior extremes or in the middle of value? Indicators often pull your focus down into the micro. Price action pulls you outward into structure and flow. Emotionally, price action is demanding. There's no green light telling you it's okay to enter. There's no red line telling you you're wrong without ambiguity. You must define risk yourself. Place stops where the idea is invalidated, not where an indicator flips. This forces a level of self-awareness many traders avoid. But that same awareness is what creates consistency over time. You stop reacting to signals and start executing plans. As the years passed, I noticed something else. Traders who mastered price action didn't talk much about setups. They talked about patience, location, and behavior. They waited. They observed. They acted decisively when the market revealed its hand, and did nothing when it didn't. Their charts were clean, not because they were minimalist, but because they were focused. They understood that clarity doesn't come from more tools, it comes from better questions. And this is where the real work begins, because understanding price action conceptually is not the same as being able to trade it under pressure, especially when the market is fast, noisy, and emotionally charged. And that's where we need to go next, into how to actually train your eye to read price, how to define high-quality locations, how to manage risk without indicator crutches, and how to build confidence in decisions that won't always feel comfortable in the moment. Because price action trading is not about being right. More often, it's about being aligned with what the market is actually doing right now, and having the discipline to act only when that alignment is clear enough to justify risk. And that transition from understanding to execution is exactly where we continue next, as this thought carries forward into the practical framework for mastering price action trading without indicators and learning how to trust what you see rather than what a tool tells you. And that is where the real edge is developed over time, when experience replaces dependency and observation replaces confirmation. And that is where we go next, as we continue from here into how to build that skill deliberately and honestly, and apply it in real markets when the pressure is real and the temptation to fall back on indicators is strongest. And you are standing there with a clean chart and a decision to make, and you must rely on your understanding of price itself rather than anything else, because that moment is where price action trading truly begins and continues as you learn to read the story the market is telling you, candle by candle and level by level and moment by moment, and you start to realize that nothing important was ever hidden behind indicators in the first place, and that the only thing you were missing before was the patience and clarity to see it, and trust it enough to act. And that is the bridge we cross next as we move forward from here, and deepen this lesson into something you can actually use when the market opens and the chart is clean, and the only voice left is your own, and the price in front of you asking what you're going to do next, and whether you're ready to answer without hesitation or excuses. Because that is where this continues, and how the next part begins and carries on seamlessly. From this point into the practical side of mastering price action trading, with no indicators needed and no place to hide when you're wrong, and no shortcut when you're right. And that is exactly where we pick up next. And continue without pause, as this sentence leads directly into the next phase of the lesson, and the next words will take us straight there as we move forward into execution and practice, and the habits that make price action trading a skill you can rely on rather than an idea you admire from a distance. And that continuation begins as soon as you say, next, by turning observation into a repeatable discipline rather than a vague intuition. Because price action only becomes reliable when you train your eye to see the same things the same way, day after day, regardless of mood or market noise. The first practical step in mastering price action is stripping the chart down to structure and asking one question before any other: where is price relative to value? Are we at an extreme returning to a prior decision area, or drifting aimlessly in the middle of nowhere? Most bad price action trades come not from misreading candles, but from trading them in the wrong location. A beautiful pattern in the middle of value is usually just noise. An imperfect pattern at a major level can be far more meaningful, because location does most of the probabilistic work for you before you ever think about entry. Once location is clear, you train yourself to read intent through behavior. Intent shows up in how price moves, not just where it closes. Strong intent looks like urgency. Decisive pushes shallow pullbacks. Little overlap. Weak intent looks like hesitation. Long wicks overlapping candles progress that requires repeated effort. You are not predicting what will happen next. You are observing who is currently having to work harder. When buyers push price up and immediately give it back, that tells you something. When sellers hit price repeatedly and can't make progress, that tells you something too. Price action is a conversation, and your job is not to interrupt it, but to listen long enough to understand which side is losing control. Entries in price action trading are deliberately boring. You are not trying to catch the exact high or low. You are entering when the market has already shown its hand enough that your risk can be clearly defined. That usually means waiting for a failed move, a retest, or a shift in behavior at a key level. This is where many indicator traders struggle, because price action entries often feel late. They are not late, they are informed. You give up the illusion of perfect timing in exchange for clarity about where you are wrong. Your stop goes where the story breaks, not where the pain begins. If price trades back into acceptance after showing rejection, the idea is invalid. That clarity is what keeps losses small and unemotional. Risk management without indicators becomes simpler, not harder. You define risk structurally. If the level you are trading from fails, you are out. If the behavior you are trading against persists, you are out. There is no debate. Position size is adjusted so that this structural stop is tolerable. This is where many people realize they were using indicators not for insight, but for emotional cushioning. Price action removes that cushion, but in return, it gives you honesty. You always know why you are in a trade and why you are getting out, and that transparency builds trust in your own decision-making over time. targets in price action trading are also behavior-based. You look for where opposing interest is likely to appear. Prior highs and lows ranges areas where price previously stalled or reversed. You pay attention to how price behaves as it approaches those areas. Does momentum slow? Do wicks appear? Does acceptance fail? You don't demand that price reach your target. You observe whether the conditions that justified holding are still present. Often this leads to scaling out rather than all-or-nothing exits. You take what the market offers when it offers it, not what you hoped it would give you when you entered. The real training happens off the live chart. Marking up historical charts, replaying sessions, journaling observations in plain language instead of indicator signals, this is where your eye develops. Write down what price did, where it did it, and how it behaved afterward. Over time, patterns emerge not just in price, but in your own perception. You'll notice where you tend to anticipate instead of wait, where you force trades in unclear conditions, where you hesitate despite clarity. Price action trading is as much about learning yourself as learning the market, because without indicators, your tendencies are fully exposed. One of the most important habits I ever developed was learning to do nothing well. Clean charts make boredom obvious, and boredom is where discipline is tested. When price is balanced, rotating, overlapping, the correct action is observation. No indicator will save you from overtrading in those conditions. Price action teaches you that not trading is a position, and often the most profitable one. The confidence to sit out comes only after you've seen enough false moves to respect how expensive impatience can be. Over many years, I noticed that traders who truly mastered price action stopped talking about strategies altogether. They talked about context, patience, and risk. They waited for price to come to them instead of chasing it. They were comfortable being wrong quickly and quiet when nothing was clear. Their edge wasn't prediction, it was alignment. They aligned with structure, with behavior, and with their own rules, and that alignment carried them through environments where indicators failed and narratives collapsed. That is the real promise of price action trading without indicators. Not simplicity for its own sake, but clarity. Not certainty, but responsibility. You stop asking tools to tell you what to do and start answering that question yourself based on what the market is actually doing right now. If you commit to that process slowly and honestly, price action becomes less mysterious and more intuitive, not because it's vague, but because you've earned the intuition through observation and repetition. If this lesson resonated with you, I encourage you to subscribe to the channel so you can continue learning through real market experience rather than shortcuts, and leave a comment sharing what you find hardest about trading with a clean chart. Because that struggle is exactly where the most important growth happens. And discussing it openly is how understanding turns into skill, and skill turns into confidence. That doesn't depend on indicators, opinions, or excuses, but on your ability to read, price manage risk, and act only when the market gives you a reason that truly makes sense.